Welcome everyone to this tutorial on debit and credit. In this video, we are going to look at three different types of questions, and we will do some examples as well. The first question that we are going to look at is what is debit and credit. Then we are going to look at what are the different nature of accounts, and what is the debit and credit rule for each of the nature of accounts. Following that, we would just look at some examples on how to make journal entries in companies' financial books, because this is really important, as journal entries are the first point of accounting. This is how accounting starts, and this is how companies record their financial transactions. So what is debit and credit? Debit and credits, they are usually, you would see these short forms for DR for debit and CR for credit. So very common, if you see DR and CR in companies' financial statements or any other financial statement like bank statement, DR means debit and CR means credit. Debit and credit are nothing. They do not have a proper definition. They are just two columns in company's book of accounts or any financial statement. Or any bank statement that you may have. So these are just two columns like this, debit and credit. So you can say debit is a left-hand column. This is a left-hand column, and credit is a right-hand column. It's a right-hand column. That's it. These are just two columns, left-hand column and right-hand column. Left-hand column debit, right-hand column credit. Moving on to our second question, which is the nature of accounts. So there are three major different types of nature of accounts. Following that, you may also see two additional nature of accounts as well. And nature of accounts, they basically come from accounting equation. I have prepared a video on accounting equation as well that you can watch, which discusses and talks about what is accounting equation. Accounting equation, basically, it's here that you can see it's A equals to L plus E. That's the short form, which basically means assets equal to liabilities plus equity. So three main nature of accounts you can see is asset, liability, and equity. The other two nature of accounts that you would see in addition to the three that I have mentioned here are revenues and expenses. So asset, liability, equity, revenue, expenses. These are all nature of accounts. Nature of accounts. And now we are going to look at the debit and credit rules for each nature of account. So asset, liability, equity, revenue, and expense. You would see that asset and expenses have same nature of account, and liability, equity, revenue have same nature of account. So these three categories have same nature of account, and then assets and expenses have same nature of account. I will just briefly explain whenever an asset increases, you debit, and whenever an asset decreases, you credit. Whenever a liability decreases, you debit. If liability increases, you credit. So this is inverse of the asset. So this is inverse. This is inverse of asset and expenses. So I think this table is a very self-explanatory. So whenever asset increases, you debit. Whenever it decreases, you credit, and whenever liability decreases, you debit, and whenever liability increases, you credit. So you can take your time and look at the table by yourself. Very self-explanatory, I would say, and I would move on towards solving questions, and you would see the application of this table. So I have four examples here, four different financial transactions that you can see in a company. So I would attempt or I would solve the first two, and these two are for you. So I would solve these two. I would solve 1 and 2, and 3 and 4 are for you to try, basically. We can follow a simple 4-step model that I have created. The first thing that you do is read the transaction very carefully. Then you identify the nature of account, whether it's cash, accounts receivable, etc. There are different types of accounts. So I've given you examples of different types of accounts: cash, accounts receivable. Other examples, uh, other examples of accounts could be other examples of accounts could be uh, rent expense, rent expense, sales revenue. So these are all accounts. And first you have to identify account, and then you have to look at the nature of the account, whether it is whether the nature is asset, or it's a liability, or it's an equity, or it's a revenue, or it's expense. So for example, rent expense is an expense nature account. So rent expense is an expense nature account. Sales revenue is a revenue nature account. So, and they would follow so you can look at the rules in the previous slide, and based on that, you would determine whether there's an increase or decrease, whether you need to debit or credit based on the increase or decrease, right? So you refer to the rule book, and then you make the general entry. So let's look at the first transaction now. The first transaction was company A. Company A purchased machinery for $100 cash. So company A purchased machinery for $100 cash. So there are two accounts involved in here. The first account is machinery. That's the first account, machinery, and the second account is cash. Both of the accounts have a nature of asset. Machinery is an asset. Machinery is an asset nature account. Cash is an asset nature account. In this transaction, one account is going up and another account is going down. So machinery is going up and cash is going down. Based on the rule book, whenever there's an increase in asset, you debit the asset. Whenever there is a decrease in asset, you credit the asset. So in this case, you debit machinery $100 and then you credit cash by $100, right? Because machinery is an asset, that asset is going up, and then cash is another asset because you have paid cash to purchase the machine. There's a cash outflow, therefore reduced amount of cash that you have in the bank now. So your cash is going down, and hence that's why it's going to be credit. Then you have company Z, which has sold goods to customer C for $50 on account. Now this is a very key term in here, on accounts. This basically means that you sell the goods on credit, sell the goods on credit, sales on credit. So this would generate accounts receivable, accounts receivable. You can actually watch my video on what accounts receivables are. That will explain you about accounts receivable. Now we look at this transaction. Company Z sold goods to customer C for $50 on account. Two things happening here. They sold the goods on account, which means that they did not receive any cash. They did not receive any cash. This should not be cash. This should be sales revenue, because you have sold the goods and you have generated the revenue. And because they have not received the cash, this credit is just sales revenue, $50. Sorry for the typo in here. Whenever asset goes up, you debit, and whenever revenue goes up, you credit. This is just based on the nature. So company Z sold goods to customer C for $50 on account. There are two accounts involved: accounts receivable, and sales revenue. You can look at the nature of the account. Accounts receivable is an asset nature account. So asset nature account, and sales revenue is a revenue nature account. You determine the nature of the account. You look at whether it's increase or decrease, and then based on the rule book, you make the entry. So in this case, accounts receivables are going up. So debit accounts receivable, and then my sales revenue is going up as well because I sold the goods. So sales revenue credit for $50. Now you can try transaction 3 and 4 using the four-step strategy, or any other method that's easier for you. So now just a quick recap on this video. So we looked at what debit and credits are. Debit and credits are nothing but just two columns of in company's book of accounts, and they are always equal. This is also important. Debit is always equals to credit. So even the transactions that we did previously, you see all the amounts were equal. Debit and credit has to be equal. If you cannot make it equal, then there's something wrong. Then there are three main nature of accounts: asset, liability, and equity. Besides that, there are two other, which is revenue and expense. Then to pass journal entries, this is to make journal entries. You can follow this model. You first read the transaction very carefully. You identify the accounts and nature of accounts. Then you can refer to the entry rule book in this video about debit and credit. Based on that, you would determine whether there is an increase or decrease in any account, and then you make the journal entry. Hope you find this video useful, and thank you for watching. If you find this video helpful, please hit the thumbs up button and subscribe to my channel. Thank you very much.